Welcome to this episode of OJ Samuel's Accounting and Reporting YouTube channel. Today we'll be discussing the title Reviewing Lessee's Lease Reporting under IFRS 16 Leases. Reviewing Lessee's Lease Reporting under IFRS 16 Leases. That is the title for this episode. So what we'll be doing, we'll be hopping through the core provision of IFRS 16 titled Leases with respect to the reporting requirement for a lessee. And then we'll be comparing it, we'll be making a case study of a quoted company's financial statement that is a lessee and how its lessee's transactions are reported in its published financial statements. So that's what we'll be doing. We're going to take in IFRS 16, look at the core provision concerning lease reporting, and then contrast it with the lease compliance reporting by a quoted Nigerian company that is a lessee and reported his transaction in his public financial statements. That is the purpose we want to do. This will enable us to concretize the understanding of the provision of IFRS 16 on lease reporting from the perspective of the lessee, and then how a quoted entity or an entity as a lessee reports its lease transaction as a lessee. So we're going ahead to share the provision of IFRS 16 and then the comparable aspects of the financial statement of the lessee. So here we go. Okay, yes, so the screen is up. You look very closely. We are only taking the section of IFRS 16 that is relevant for our episode. So you can see the title there, Lessee Recognition. So we're going to hop through this, summarily. Recognition, it says, at the commencement date, a lessee shall recognize a right of use assets and a lease liability. In IFRS 16, from the perspective of lessee, there's nothing known, or there's something no longer known as a finance lease or an operating lease. No. In the IFRS 16, the focus for a lessee is to recognize the right of use asset associated with the lease. So the emphasis is not whether it's on finance lease or whether it's on operating lease. The consideration as to whether an item is a finance lease or operating lease is on a perspective from the lessor only under IFRS 16. Beside the lessor, from the view of the lessee, is about recognizing the corresponding right of use asset and lease liability. So we no longer emphasize whether it's a finance lease or whether it's an operating lease under IFRS 16. So we are continuing with the reading on when does the lessee make a recognition. So the standard case, at the commencement date, a lessee shall recognize a right of use asset and a lease liability. I repeat, at the commencement date, a lessee shall recognize a right of use asset and a lease liability. So these items are recognized concurrently. A debit to right of use asset account and a credit to lease liability. Now we'll go ahead. How is the measurement done? For the entry to be made for right of use asset, how is the right of use asset measured? So the standard says that at the commencement date, a lessee shall measure the right of use asset at cost. At the commencement date, a lessee shall measure the right of use asset at cost. So let's go to the composition of what makes the right of use asset. These are the components of right of use assets. The standard states in paragraph 24 that the cost of the right of use asset shall comprise A, the amount of the initial measurement of the lease liability, I'll describe in paragraph 26, so we're going to get there. The amount of the initial measurement of lease liability. That lease liability itself is the present value of the future payments on a lease. The present value, the discounting, or the future cash flow outflows that arise from a lease transaction. That present valuation of those future cash flow is the lease liability. So as part of the component of right of use asset, an entity includes the amount of the initial measurement of the lease liability. That is one. Two, any lease payment made at or before the commencement date. We will need to clarify, commencement date is the date a lessor makes a lease item available for use to the lessee. commencement date is that date that a lessor makes a lease item or the underlying asset, as we refer to it, available for use to the lessee. So apart from the initial measurement of lease liability, which I've explained to be the present value of 4 payments, lease payments, that flow from or that are inherent in a lease contract. Secondly, we'll add any lease payment made at or before the commencement date, less any lease incentive received. Any form of payment whatsoever made by the lessee on or before, at or before the commencement date is also added as part of the measurement of right of use assets. Thirdly, any initial direct cost incurred, any initial direct cost, what you can liken to a transaction cost for a borrowing cost, anything you can liken, also the agreement fee, sign off, legal, all of those kind of costs. So any initial direct cost incurred by the lessee, and for an asset that will need to be dismantled, that will need to be decommissioned, that will need to be returned, removed from a certain location back to its original state or to the lessor, certain costs are inherent. So we make estimation for those costs, as we normally do when we apply provisioning under IFRS 37. So the fourth cost component are an estimate of cost to be incurred by the lessee in dismantling and removing the underlying assets. That is decommissioning cost, as we call it, restoration cost, restoring the site on which it's located, or restoring the underlying asset to the condition required by the terms and conditions of the lease, unless those costs are incurred to produce inventories. So there are 4 categories of costs that make up the amount for right of use assets. The initial measurement of the lease liability, which is the present value of the cash outflow that will arise on that lease. Secondly, any lease payment made before or at the commencement date of the lease, less any incentive received. Thirdly, any initial direct cost incurred. And fourth, the estimate of cost to be incurred by the lessee in dismantling, removal, restoration, or restoring of the underlying lease. These are the 4 components of costs or expenditure of money that make up the initial value, the measurement of right of use assets. That is the provision of IFRS 16. Now, I want to talk briefly on what we refer to as the exceptions. There are certain exemptions, right, to this concept of IFRS 16. When the underlying item, when a lease contract is a short-term lease, meaning that lease that has a term or span of between 12 months or less, we do not go into the recognition of right of use assets. We do not. What happens? The lease payment is expensed, accounting period in which that lease contract is entered into. So for any lease agreement that has a tenure of 12 months or below, that is expensed. Or if the lease is an item, if the underlying asset is of low value, it's about certain materiality concept in a way, a kind of materiality concept in a way. When the underlying asset is of low value, there is no need recognizing right of use asset. Any lease payment associated with that underlying asset leading to the lease is expensed within the accounting period. So when a lease is a short-term lease, meaning the tenure is between 12 months and below, and the underlying assets of low value, right? Under this condition, right of use asset is not recognized. And when we say right of use asset is not recognized, that amount is expensed or written off within the accounting period that the lease transaction arises. So that is that on the treatment of right of use asset from the lessee, the component of right of use assets, and the recognition exemption when right of use asset is not required to be recognized. So that's a quick update on that. Then we'll go over to subsequent measurements. At initial measurement, we've mentioned the 4 components, right? The 4 components. We say the initial measurement of the lease liability itself. We mentioned initial direct cost associated. We mentioned any payment made at commencement or before commencement of the lease, less any incentive received. Then we mention estimates that will be incurred in decommissioning, in removal, in restoration of the underlying assets. These all components are the elements of cost that make up right of use asset at initial measurement. Subsequently, there is a way right of use asset is measured, and that is the provision contained here under paragraph 2930 of IFRS 16. It says, after the commencement date, a lessee shall measure the right of use assets, applying a cost model unless it applies either of the measurement model described in paragraph 34 and 35. Generally, most items that yield, to the lease contract kind of agreements are often, not always, are often item of property, plant, and equipment. An item of investment property. That is the nature. So generally, subsequently, the cost model is used. The cost model as we have under IFRS 16 is used for the subsequent measurement of right of use assets. We want to emphasize, is there a case of, is there a finance lease, is there a capital lease? We know that a lease may be that entered into for the purpose of owning, where the lessee intends to exercise that right of option to own the asset at the end of the lease term. It may be such where it is purely, in quote, a kind of a hiring agreement that the lessee does not intend to own the underlying asset. That is clear. But whichever way, whichever context we're putting it, the focus of IFRS 16 from the perspective of the lessee is to recognize the right of use asset, and not about the focus on whether it's a finance lease or whether it's an operating lease. It's about quantifying monetarily the present valuation concerning all cash outflow that will arise from the lessee to the lessor. The valuation of the economic worth, the present valuation of the cash flow is the focus of IFRS 16, not as to whether it is a finance lease or whether it's an operating lease. So when this valuation has been determined initially, subsequently, how is this right of use asset accounted for? How is it measured, rather? That is the focus here, that is measured using the cost model, but there are exceptions, right? Which we're going to look at shortly. When we apply the cost model, we're applying the provision of IFRS 16 property, plant, and equipment. And paragraph 30 here says, a lessee shall measure the right of use asset at cost, less any accumulated depreciation and any accumulated impairment losses, and adjusted for any remeasurement of lease liabilities specified in paragraph 36C. Sometimes there may be a need to revise a lease agreement. Revision of a lease agreement may lead to increment in subsequent lease payment to be made, or to reduction in subsequent lease payment to be made. Whether there's an increase whether there's an incremental effect of a lease agreement, reassessment or modification, or whether there is a decrease in the lease, in the consequence of the lease assessment, reassessment, or lease modification, that amount of that incremental or differential reduction is reflected in the current amount of the right of use assets. That is the purpose of this clause 30B, and adjusted for any remeasurement of lease liability specified in paragraph 36C. Paragraph 36 deals with remeasurement of lease. When there's need to revise, to remeasure, that remeasurement may lead to an incremental consequence or a decreasing consequence. So that is cost model. Cost model is used to measure right of use asset subsequently. Now we're going to want to look at the exception where the cost model is not used. Where the cost model is not used. So we come here, I want to read paragraph 34. It says, if a lessee applies the fair value model under IFRS 40 investment property to its investment property, the lessee shall also apply the fair value model to right of use assets that meet the definition of investment property in IFRS 40. So when the underlying asset in the lease is an investment property, and the lessee applies fair value model, we know under IFRS 40, the preferred standard measurement model is fair value. Alternatively, when fair value cannot be determined, the cost model is used. But the fair value is the preferred and the ideal measurement basis for investment property. Therefore, when investment property is the underlying asset of a lease for a lessee, and that lessee accounts for investment property using fair value, that fair value should be applied to the subsequent measurement of right of use assets. That is the alternative recognition provided in IFRS 16. Apart from the cost model, which is applying the cost model principle in line with IFRS 16 property plant and equipment, an entity is required to apply the fair value model if the underlying asset is an investment property, one, an entity uses or applies the fair value model in reporting investment property. Therefore, the right of use asset that flow from an investment property that is an underlying asset should be measured subsequently using fair value. That is that about that. That is that about that. And also, an entity may also choose, rather using the cost model for item of property, plant, and equipment. For item of property, plant, and equipment, an entity may choose to use the valuation model in IFRS 16. That is also allowed. So summarily, the cost model could be used, the valuation model could be used for item of PPE generally, and then the fair value model could be used for investment property that is the underlying asset in a lease transaction. That is how right of use asset is measured subsequently. We move on to the other core component, lease liability. Recall at start, we said a lessee recognizes, right, a right of use asset on one hand and a lease liability on the other hand. That is the corresponding entry. So how is the lease liability measured initially? That I'd explained. I had explained that the cash outflow or the lease payment to be made by lessee is discounted at the present value. The question is, what is the discounting factor? Or what is the discounting rate? So we read paragraph 26 of IFRS 16. It says, at the commencement date, a lessee shall measure the lease liability at the present value of the lease payments that are not paid at that date. So it's the future cash flow, the future payment, not the one that has been paid. So at the commencement date, a lessee shall measure the lease liability at the present value of the lease payment that are not paid at that date. The lease payment shall be discounted using the interest rate implicit in the lease, if the rate can be readily determined. If that rate cannot be readily determined, the lessee shall use the lessee's incremental borrowing rate. So in summary, it's about ascertaining what is the lessee's incremental borrowing rate, or what is the interest rate implicit in the lease. So the kind of you can liken interest rate implicit in the lease to what you call the effective interest rate. Yes, you can liken it to the effective interest rate. What is that rate that can discount expected cash outflow, or that can discount the future cash lease payment to a value that will equate the cash price for that item if it were to be bought in cash? What is that interest rate that can discount the future cash payment, lease payment, or expected cash outflow as lease rental to a present value, to an initial amount that equals the cash price if that underlying item were to be bought on cash or not to be leased? That interest rate is referred to as interest rate implicit in the lease. Generally speaking, that is the effective interest rate. So that is the rate we use in discounting the total cash payments or lease payments, not the payment that has been made, no. The one that are not yet paid, that will be paid within the lease term or lease period. So that rate that discounts it to an initial amount that equates the cash price for that underlying asset. If the asset were not to be given out on lease, that rate is the interest rate implicit in the lease. That is how lease liability is measured initially. So as you credit lease liability for that amount, you debit right of use asset for that amount. But there's a difference. In right of use assets, apart from the initial measurement of lease, it includes the other cost element we mentioned. The initial direct cost we mentioned, the all payments made at or before commencement that we mentioned, and the estimate of the cost of decommissioning, removal, or restoration associated with the underlying asset. So these other three items are the differential cost that will make a right of use asset not to be exactly the same with lease liability at initial measurement. That is that on lease liability. And the components of lease liability are any fixed payment to be made that are not yet paid, any variable lease payment to be made, not yet paid, amount expected to be payable by the lessee under residual value guarantee. When a lessee guarantee certain amount that will be paid at the end of the tenure or the lease term, that amount is part of the components that make up the lease liability. All these are the future cash flows that are discounted using that interest rate implicit in the lease. And also, the exercise price of a purchase option, if the lessee is reasonably certain to exercise that option. When a lessee has an option to purchase, in an option is an exercise amount, right, that is payable by a lessee to exercise his right, right, when it intends to purchase that item, meaning that kind of lease that will translate what we call a finance lease that will pass on ownership, right, to the lessee. So any such exercise, any such purchase option, right, exercisable at the end of the lease term. That forms part of the cash flow considered in determining the initial amount for lease liability. Then lastly, payments of penalties for terminating the lease if the lease term reflects the lessee exercise an option to terminate the lease. When there are penalties for terminating a lease agreement, right? And from looks of things, a lessee contemplates the possibility of terminating the lease before the end of its term, right? So that penalty forms part of the cash flows that are considered, that are discounted with the interest rate implicit to get the present value of the lease liability. So these are the components of lease liability. And we've examined the component of right of use assets. So let's take note. So move on. Subsequently, how is lease liability measured? So the lease liability is a kind of a kind of a financing transaction, so to speak. It's kind of a financing transaction, so to speak. And that reflects in the provision of paragraph 36 here. It provides, after the commencement date, a lessee shall measure the lease liability by A, increasing the current amount to reflect interest on the lease liability. Just as you calculate an interest expense, right? The interest rate implicit percent times the current amount at the beginning of the period will give you the interest expense component at the end of that period. Yes. So the interest rate implicit in the lease, right, multiplied by the current amount of lease at start will give you the interest rate expense or the lease interest expense. Yes, the lease interest expense or the lease premium expense within or at the end of that period. That is the amount by which the lease liability increases subsequently because there's a time value of money. Secondly, by reducing the current amount to reflect the lease payment made, yes, there is the payable at start, which is the lease liability, increased by the lease interest expense, decreased by payment made by the lessee. That's straightforward and makes sense. The opening balance of the lease liability, which is a payable, increased by the financing cost, the lease expense, interest expense, less any payment made by the lessee. And thirdly, remeasuring the current amount to reflect any reassessment or lease modification. Now, as I said before, sometimes there's need for reassessment, sometimes there's need for lease modification. Probably the term, based on events that are coming up, there's need to renegotiate a lease. A renegotiation, a reassessment, or a modification of a lease may trigger up incremental amount of cash flow to be paid as leases, or may trigger a reduction in the amount to be paid as leases. Whatever that may be, this has an effect on lease liability. If the consequence of a reassessment or a modification leads to an increased lease obligation, lead to an increased cash lease payment, that will increase the lease liability. If a reassessment or modification leads to a reduction, that will reduce the liability. So these are the three components that go to adjust the opening balance of a lease liability. The initial measurement of lease liability plus the lease interest expense for the period, less payment made by the lessee, and then should be adjusted for any remeasuring effect based on lease reassessment or lease modification. So these are the components that are considered in arriving at a certain measurement of a lease liability. Then we'll move on to presentation. What are the items to be presented in the face of a financial statement? What are the items to be presented in the context of a right of use asset flowing from a lease, from the perspective of a lessee? So the standard provides a lessee shall either present in the statement of financial position or disclose in the note A, right of use assets separately from other assets. Or if a lessee does not present right of use assets separately in the statement of financial position, the lessee shall include right of use asset within the same line item as that within which the corresponding underlying asset will be presented if they were owned. For example, for an item of motor vehicle under a lease, an entity present right of use assets and write the current amount for that right of use asset. Alternatively, that amount is included within property, plant, and equipment, and even in the notes in the PP schedule. When we go to motor vehicle, that motor vehicle on lease is included within there. Is included. So when you see property, plant, and equipment, a given amount is stated, that line item may contain an underlying asset that gave right to right of use asset. That is one option. The other option, which is the first one, is to present it separately, right of use asset, this amount. Even though the underlying asset is a motor vehicle, but it is presented separately, right of use asset. So the other option is to include the amount of your item of property, plant, and equipment. Then the notes, you are to disclose that this portion or this item, right, is a right of use asset arising from lease of such and such. So that is that. So I repeat, right of use asset separately. A lessee shall either present in the statement of financial position or disclose in the note the right of use asset separately from other assets. If a lessee does not present right of use asset separately in the statement of financial position, the lessee shall include the right of use asset within the same line item as that within which the corresponding underlying asset will be presented if they are owned, and disclose such line item in the statement of financial position. Disclose which line items in the statement of financial position include those right of use assets. So when an entity includes right of use asset within the same line item as that within which the corresponding underlying assets will be presented as if they are owned, and then it shall disclose which line item in the statement of financial position that include those right of use assets. That is a presentational requirement. Secondly, an entity shall also disclose lease liabilities, shall present in the statement of financial position or disclose in the note. B, lease liabilities separately from other liabilities. Lease liabilities separately from other liabilities. If the lessee does not present lease liabilities separately in the statement of financial position, the lessee shall disclose which line items in the statement of financial position include those liabilities. So it is required, just as right of use assets, lease liability should be separately presented in the statement of financial position. But when it is included as part of other category of liabilities, there should be a note, right, that discloses the line item that contains, meaning that general liability, other liabilities. There should be a note that specifies the amount of lease liability contained in that particular line item in the statement of financial position. So that is an aspect of presentation required under IFRS 16. Now we read on to the other aspect of the disclosure in paragraph 48 to 50. We'll start with 48. It says, the requirement in paragraph 47A does not apply to right of use assets that meet the definition of investment property, which are represented in the statement of financial position and investment property. When the underlying asset is an investment property, it is presented separately. So it says, what we've just read before does not apply to right of use assets that meet the definition of investment property, which are represented in the statement of financial position as investment property. So when the right of use asset has an underlying item as investment property, what should be presented is investment property. So all of these long leases on building, on property, right? All of those long-term leases, that of course they are not short-term. What should be presented there should B, investment property. Then you know to clarify that investment property is an underlying asset upon which the right of your asset is measured. So that is what paragraph 48 is stating. Paragraph 49 states, in the statement of profit or loss and other comprehensive income, a lessee shall present interest expense on lease liability separately from the depreciation charge of the right of use asset. Interest expense on the lease liability is a component of finance cost, which paragraph 82B of IS 1 requires to be presented separately in the statement of profit or loss and other comprehensive income. So this is it. We spoke about right of use assets, and now it is measured either the cost model, revaluation model, or the fair value model, right? Now, under the cost model, it is going to be depreciated over either the useful life of the underlying assets or over the term, the lease term, over the lifespan of the right of use assets. It is depreciated. Now recall that we had said for lease liability, there's an interest expense, there is lease interest expense component. When we said the interest rate implicit times the opening current amount, we give us the lease interest expense component. So this portion is not merged with the depreciation. Depreciating right of your asset is a separate line item, and then the lease interest expense on the lease liability is a separate item that is reported under finance cost. That is what paragraph 49 is emphasizing. Depreciation should be presented separately. The depreciation charge of right of your asset should be presented separately, and then the lease interest expense on lease liability should be presented as part of a finance cost in the statement of comprehensive income, or statement of profit or loss and other comprehensive income. That is the provision of paragraph 49. Now, paragraph 50 says, in the statement of cash flow, a lessee shall classify in the cash flow. Let's take note, cash flow now. The lessee shall classify cash payments for the principal portion of lease liability within financing activity. So for a lease payment, there are two components, the interest expense component and the cash portion and the principal portion component, principal and interest. The installment is one, but that's two subdivisions, the principal component and the interest expense component. So the principal portion component is presented, the cash payment or cash flow on that principal component is presented under financing activity in the statement of cash flow. B says the cash payment of the interest portion of the lease liability applying requirements in IS 7, sum of cash flow for interest paid, and short-term lease payments, payments for leases of low-value assets, and variable lease payments not included in the measurement of the lease liability within operating activity. Two things. Now, when it comes to the cash payment for the interest portion, it is evaluated in the context of IS 7 to decide whether, depending on whether an entity wants to own the asset at the end, that will make it an investing kind of activity. So the interest portion related thereon, or rather paid thereon, will be maybe presented as part of the investing cash outflow. Rather, it's an investing activity expense. Now, let's flip it the other way around. Now, it may be, that the entity does not intend to own that asset at all. What you can liken to a typical operating kind of, operating lease, sort of. A typical operating lease, sort of. So it is left for the entity to look at the context of a lease contract to decide whether that interest may be presented as operating activity. So if you look at provision B, it does not specify whether you are represented as financing, investing, or operating, and then they should evaluate is use of that underlying asset is a main business activity in deciding whether to present it as an operating cash outflow, right? An investing activity cash outflow, or even a financing, as the case may be. So that is why B, so it has to be evaluated by applying the requirement of IS 7. But for other short-term lease payments, those lease tenure of 12 months and below, leases of low value item. Generally, what are low value items? The standard gives an absolute criterion. When the item is new, it's not a case whether it is bought second hand or it has been used before and all of that. If that underlying item is new, will it be considered of low value? When that item is new, will it be considered of low value? It's not be considered as low value, right? Right of use asset is recognized in line with IFRS 16. But when that item is considered of low value, right of use asset is not recognized. Therefore, like the short-term lease of low value assets the lease payments are expensed within the period that they arise. Therefore, all cash flow payments, cash flow effects of short-term leases, payment on lease of low value assets, and variable lease payments not included in lease liability are all presented within operating activity. So all these items, the short-term leases, low value asset leases, and variable payments that are not recognized as part of the lease liability. All of these are presented as cash outflow within operating activity. So that is the presentation. So we go over to the disclosure. What are the disclosure required typically? What are the disclosure required? So we read, the objective of the disclosure is for lessees to disclose information in the notes that, together with the information provided in the statement of financial position, statement of profit and loss, and statement of cash flows, gives a basis for user of financial statement to assess the effects that leases have on the financial position, financial performance, and cash flow of the lessee. Specifically, we go to paragraph 52. It states, a lessee shall disclose information about its leases for which is the lessee in a single note or separate section in the financial statement. However, a lessee need not duplicate information that is already presented elsewhere in the financial statements, provided that the information is incorporated by cross-reference in a single note or separate section about leases. Paragraph 53. A lessee shall disclose the following amounts for the reporting period. So these are the disclosure required. A lessee shall disclose the following amount for the reporting period. A, depreciation charge. A, depreciation charge for the right of use asset by class of the underlying asset. What are the classes? Are they what? Motor vehicle, for example, land, for example, building, for example, plant, office equipment. What are the classes? So an entity shall disclose the depreciation charge of right of use asset by class of the underlying asset. That disclosure will be seen. For other disclosure, the interest expense, second please, let me align it. Interest expense on lease liabilities. Now that interest expense we mentioned, the lease interest expense, the interest implicit times the current amount at the beginning of the period. So for the whole of the accounting period, the interest expense on the leases will be disclosed. C, the expense relating to short-term leases accounted for applying paragraph 6. This expense need not include the expense relating to leases with a lease term of 1 month or less. Paragraph 6 of IFRS 16 says, when an item is a short-term lease or the underlying assets of low value, it should not be recognized as right of use asset. So it's an exemption to the recognition of right of use asset. That is the provision of paragraph 6 of IFRS 16. So where there are such, unless you disclose the expense relating to short-term leases accounted for by complying to paragraph 6, meaning by not recognizing a right of use asset, this should be disclosed. Number D, the expense relating to leases of low value assets accounted for applying paragraph 6, same thing. Paragraph C is for those short-term leases. Paragraph 2 is for those low value assets, those leases flowing from low value assets. So the expense which are not in quote capitalized or recognized as part of right of use assets should also be disclosed. These are expense, just like those are related to short-term leases. Number E, the expense relating to variable payments. The expense relating to variable payments not included in the measurement of lease liabilities. Ordinarily, when we read the component of lease liability, we saw fixed payments, variable payments, right? Excess price for option at the end of the tenure of the lease. potential penalty for terminating or canceling a lease term before the end of the tenure. We saw those four components as the components, we read it before, as the component of lease liability at initial measurement. It is possible that certain variable lease payments may not be included in lease liability. Maybe they're insignificant, maybe they're just occasional, maybe they're just, they are not routine. They are not routine. They come up along the way, they come up by way of a modification, they come up by way of reassessment and all of that. So there are some variable leases that may not be recognized or may not be part of lease liability. So when expenses are incurred in that aspect, the standard requires such expense to be disclosed. So the expense relating to variable lease payments not included in the measurement of lease liability. So these are the disclosure required by lessee. Then number F, income from subleasing right of your asset, when that applies, when there's a subleasing, the income that flows from subleasing right of your asset, that should be disclosed. Then total cash outflow for leases. The total cash outflow should be disclosed. Total cash outflow for leases should be disclosed. And additions to right of use assets. The increase in the year, meaning the new right of use assets that are recognized in the year, gains or losses arising from sale and leaseback transaction, that is where they apply. And lastly, the current amount of right of use assets at the end of reporting period by class of underlying asset. Now let's simplify this. Picture your typical PPE schedule. PPE schedule. That's going to show the gross amount. That's going to show the addition in the year. That's going to show disposal. That's going to show write-off. And that's going to show reclassification, for example, and then arriving at the gross closing amount. Right? Then you then have the portion that's going to show the depreciation charge for the year, as the case may be. You are going to have the one that has to do with depreciation on right of use asset terminated or that came to an end within the period. So those kind of aggregation reporting, that is what that is what you can achieve. That's what you can do in achieving the disclosure required under information J. The current amount of right of use assets at the end of reporting period by a class of underlying assets. So the kind of right of use asset schedule, chronically movement from beginning of the period to the end of the period. So these are the disclosure required under IFRS 16. So we're going to hop over quickly and then go over to a typical financial for a quoted company whose name will not be disclosing. So start with this. This is the lease policy for this company. Now we expect that the company has worded this policy appropriately as a lessee in context of IFRS 16. We expect that this has been properly worded, right? Now, but there's something here that is not sitting well. There's something here that is not sitting well. I read, it says, the wording does not sit well for an accounting policy. The lease liability is initially measured at the present value of the lease payment that are not paid at the commencement date, discounted by using the rate implicit in the lease. If this rate cannot be readily determined, the lessee uses its incremental borrowing rate. Now, when an accounting policy is being written, it should be particularized. It should be, it should have a mark of the entity that is reporting it. Rather than saying, if this rate cannot be readily determined, let me highlight that particular portion. If this rate cannot be readily determined, the lessee uses, it should be the company uses. The company uses. That would mean, your policy is not a copy and paste. It is reflecting a constancy in the wording of your policy. Now look at the first paragraph. It says, the company assesses whether, in the second sentence, it says, the company recognizes a right of use asset and a corresponding lease liability with respect to this, as we have read in the standard anyway. Now, how come here it is stating if this rate is not reliable, the lessee uses, it should be the company uses. So what I want to draw out now is the need to be consistent, the need to make sure the wording of a policy is coherent with the structure and expression used in presenting that. That is very important. So we are not going to bother about the lease policy. We want to intend and they want to assume, and it is expected that it corresponds fully, right, with the provision, with the prescription of IFRS 16. So we won't go through all that because that's going to take much further time. Now look at the state of financial position of this company. If you look at under the non-current asset, you see right of use assets, with no 15B. This is that part where the standard states that at the commencement date, a lessee recognizes right of use assets and lease liability for the initial amount of a lease. So this is the right of use asset that has been admitted or brought into the books, and there's going to be a lease liability at the other side. So this is the right of use assets on one side. So if you go to the liability side, this is the liability side. This is the lease liability presented as note 28. Lease liability. Look at it. Yes. This is it. This is it. Note 28. And you are going to notice something. How come that this lease liability is presented under current liability? The lease liability portion for non-current has nothing. So that simply means that the portion of the amount payable remaining on this lease and the future lease interest expense are for a tenure of 12 months or below. The remaining lifespan or the time span, but for the reporting date, is 12 months or below. But the point here is that the right of your assets under assets and the corresponding lease liability are on the other side, lease liability. So this is fine. We'll go to the note. There's a note 15. If we go by, there's a note 15 associated with right of your assets, note 15B, and there's a note 28 associated with lease liability. So let's go to the note. Let's go to the note to see how it pans out. Let's go to the note. This is note 15B. Now, I spoke about preparing something likened to a PPE schedule. So 15B is the right of use asset schedule, chronicling the specific item that make up the right of use asset, the opening balance, additions, modification, derecognition. You get the closing balance gross at the end of the first year. We become the opening balance for the second year. Then additions, modification, derecognition, you get for that of the current year. Now followed by the accumulated depreciation and impairment losses. We can see it. The accumulated depreciation and impairment losses for all of these. So they're all stated as well for the land and building. So the underlying asset for this company are land and building. Land and building. These are the underlying assets for this company, right? So they stated the accumulated depreciation and impairment losses, and then they stipulated the depreciation, the modification for both year, and then they arrive at the carrying amount. They arrive at the carrying amount. So this disclosure enables the fulfillment of many of the presentational and disclosure items we had considered before. When we talk about the, listing out the underlying asset, the gross carrying amount at the end, then we're just going to go to the other disclosure dealing with the interest expense, dealing with the depreciation charge. In fact, within here, we can see the depreciation charge here for 2023, for example. Look at the depreciation charge. This is the amount for land, building, and then the total. Probably the land is a limited life land, for which reason it's been depreciated. So you can see the total for depreciation for the year 2023. For depreciation, we can see that of 2022. Within the year, there was a lease modification, as you can see. Right? So all of these things are reflecting those presentational and disclosure requirements expected under IFRS 16. Very key. Now let's go over to the lease liability. This note, if you recall, this is note 15B dealing with right of use assets from the statement of financial position. Yes, that's what this note is dealing with. Now I want to go to the lease liability itself, the lease liability, the corresponding lease liability. Now look at the lease liability. For lease liability, we have the aggregation again, the opening balance, addition, there was no addition during the year, the consequence of modification, interest expense, like we said, three things. You know, we said subsequently, lease liability is made up of the opening balance as increased by the lease interest expense, as decreased by payment made, and any measurement effect of modification or reassessment. That is what we are seeing in the note playing out. Simply this component. The opening balance, as you can see on January 1, there was no addition. The modification that arose within the period, the interest expense that increased the lease liability, and then payment made that reduced the lease liability. So this is what we are saying. This is what we are saying. Now, they don't want further to give a breakdown of the number of years. They say the company has entered into leases on a property portfolio consisting of certain office and residential apartments. They are being specific. Consisting of certain office and residential apartments. These leases have terms of between 2 and 5 years. Now, if you look at it, for the land, if you look at whether for the land, the way this portends, look at the lease term. Look at the lease term you are seeing here. Those that have the lease term of between 0 to 1 year, 1 to 5 years, and these are certain office and residential apartments. So what they've done is to disclose further that this amount are flowing from specific items. They are about their offices and residential apartments, right? Which they broke down into land and building. So this is the tenor remaining for the lease concerned. You can see for 2023, no lease item has a tenor of over 1 year left, no. But they had it in 2022. In 2023, look at the lease remaining has a tenor of 1 year and below. That is the reason you did not see lease liability under non-current liability. And this justifies and sustains the consistency in the presentation. So we are done with the right of your assets in the state of financial position, the corresponding lease liability in the state of financial position, the disclosure required for all of these, as looked at in the standard when we started, and certain presentational item. Now let's go. What about the depreciation charge and the interest expense connected with these lease transactions? What about them? So let's go and see how we can get those out. If you look at here, this is statement of comprehensive income or statement of profit or loss and other comprehensive income. Look at them. Now, this company has done a function of essence method of classification. In Nigeria, based on reporting guideline issued by the FRC, even when you do a nature of essence classification, you are still required in the note even when you do a function of essence method of classification, you are still required in the note to do a nature of expense disaggregation. When you classify marketing and return expense for a certain amount, the note must give us a disaggregation of the component of the relevant item that make up the marketing and return expenses. Same thing, administrative expenses. There must be a breakdown that gives the makeup. Very important. So if you look at here, the division charge is not obvious here, but when we go to the note, we should be able to see it, even though we've seen it in the movement in the right of view asset schedule, if you recall. We saw it in the movement in the right of view asset schedule. So I mean, if we go to 11C, we'll begin to look out for it. Then what about the interest expense? The lease interest expense associated with underlying assets that is on lease. If you follow what we read under the disclosure and presentation, that should be presented as part of your finance cost. So meaning within this note 10 here, within this other called note 10, it should be part of what makes up this note 10. So we're going to go to note 11 and 10 to check this out. Note 11 and 10. So we go here, this is note, okay, we've gone to note 15, we've gone to lease, and this is, yes, look at the notes. Look at this is note 11, note 11C. In that classification they did then, by function, this is a breakdown of the specific nature of the expenses. So if you look at this line item, depreciation of property, plant, and equipment, and right of your asset, they added everything together. Therefore, the depreciation of right of your asset is contained within here. That is that one we saw in that movement. And if I'm to go back there quickly, can I quickly trace it? Yes, look at under the right of your asset. When I scroll down here, look at depreciation. Look at, so this is the depreciation component of the right of your asset for 2022. This is it. For 2023, this is the depreciation component. So all of these depreciation are included in what we are looking at now. They're included in this depreciation we are looking at now. So this stamps. And recall, the standard emphasized that they should be presented separately from the interest expense, from the lease interest expense. So this is the depreciation charge. So we now let's go to note 10, dealing with interest finance cost. Look at note 10 here. Note 10, dealing with finance cost. We can see under finance cost, look at it here. Interest expense on financial liabilities stated. Interest expense on financial liabilities. So within this financial liability is the lease interest expense associated with the lease of the underlying asset. So that lease liability on which we compute the interest rates implicit in the lease multiplied by opening balance, the interest expense thereon is contained here. Is contained here in this 38,430,966 for 2023 and 12,782,244. So these are the interest expense. This interest expense line item contains the lease interest expense arising on the lease liability. So that is not about us. So by and large, this entity has done a whole lot. Now, if we scroll down, analysis of interest expense on financial liability, you see, this interest expense we mentioned, this 38,439,000. If we scroll down, this is the breakdown, this is the composition of interest expense. We can see here interest expense, lease liability. This is the portion on the lease liability. Apart from interest on loan, interest expense flowing from employee benefits for certain reason, right? So this interest expense is on lease liability. So this entity has largely to a very great extent complied with the provision of IFRS 16 on reporting lease transaction from the perspective of the lessee. So with this, we come to the end of this episode. It's been a long one, but it was necessary. Review lessee's lease reporting under IFRS 16 leases. Reviewing lessee's lease reporting under IFRS 16. So I want to invite you to please follow what we've done in the long one. Share it among your, share it with your colleagues, your staff in the office, your team, and the rest. They should go through what we've done and then pick the financials you're working on as a consultant, or you also may be a preparer of financial statements. You may be a reviewer, you may be a senior auditor. So follow what we've done to track and to ensure that the reviewed lessee's lease reporting in line with IFRS 16 leases comply with the provision of the standard. Thank you for joining us in this long episode. My name is OJ Samuel. See you in another episode. Please ensure you share our video, like them, make your comment, let us have your question, your commentary, your observation, and your addition to what you've shared. And ensure you help us share our link widely, subscribe, invite all your colleagues to subscribe and to join what we're doing as we push towards excellence in financial reporting. Thank you and bye for now.